everybody, and we've got a presentation here that I'm just going to run through as briskly as we can, so there's plenty of time for questions. But our presentation in full is available on our website, so if you see us scanning through a few slides, then please do look at it on the website. Start off though with a little bit of an overview of Telford Homes, just in case you don't know anything about us. We are a London developer, and that's really the most important thing. We specialise in London, both in planning, designing and building, and we have all of our own building work in-house, so we do all of our own schemes, and we're the main contractor effectively, with subcontractors working underneath us. And we've built the business up really by specialising in brownfield and regeneration opportunities, concentrating really in parts of London where there aren't enough homes being built. And that's really the thing that underpins our business model. The fact that there aren't enough homes in London means that we know that no matter the ups and downs and the peaks and troughs that you sometimes get in the housing market, that building homes in London at the right price point will ultimately be successful, and I think we've proven that time and time again over the last 15 years or so. So one way or the other, that's the driver behind the business, and there's a lot of opportunity in terms of the future of London, which I'm going to take you through as we go through this presentation. Just to kick things off really, our strategy and where the business is in terms of its direction. Over the last couple of years we've changed a few things as the business has grown, but equally some things have stayed the same. In terms of changing things, as the business has got bigger, we've increased the average site size. So now we're looking at a site of maybe 50 plus units. That's because we're able to deal with larger schemes, and we get better economies of scale from doing that. We've also broadened our geographic horizon, and I'll just show you a map of our area of operation. The gold boroughs here, looking at the whole of London, are our historic traditional area of operation, and the blue boroughs are where we've started to look over the last 12 months for new sites. The reason we're doing that is not because there's a shortage of opportunities in the gold boroughs, there definitely isn't. We've been very successful buying some land in those boroughs in the last few months. But instead of that, the blue boroughs in particular are areas where they are pro-development, particularly say Brent, Ealing, Wandsworth, Croydon, and where in build to rent, which is something we're going to come back to in a little more detail later in this presentation, build to rent investors are keen across London, and we don't want to be the East London developer when talking to build to rent partners. We do think our skill set is transferable across London. We've got a supply chain that operates across the whole of London, and we know the planning environment, so we feel comfortable in terms of extending our geographic reach. So those are things that are changing in terms of geography, size of site. Things that aren't changing though are the focus on what we call non-prime locations. So we still aren't doing anything where the price point is in excess of £1,000 per square foot, and actually normally considerably less than that. The average price of an open market home in our development pipeline is just over £530,000, so below the average in London, and that's important. I talked about the fact that there aren't enough homes in London. Supply and demand in housing doesn't really work in the same way as other things. It's not that we keep the price keeps going up when you're not building enough, because affordability is a big part of that equation as well, and we want to be building homes that people can actually afford to live in. The other thing that's not changing is we're maintaining the fact that we forward sell, so we de-risk the business wherever we can. Historically we've done that to individuals, and of course more lately we've started to do that to build to rent investors. And in terms of looking at that in a bit more detail, I'm just going to take a second to talk about the market context and where we see the market, and then we'll come on to what we're doing in terms of individual sales market and build to rent. I talked already about the demand and supply dynamic. I'm just going to show you a couple of these charts on the page in front of you now, demonstrate that in a bit more detail. So the chart in the top right is London population versus completion of new homes in London over the last 25 years. Population is the gold line that you can see going up all the time. Completions of homes is the red line that doesn't. Equally, although you can see it's sort of slightly spiking in 2016, if you look at the graph in the bottom left and annual housing starts per year in London, you'll notice that that's fallen into 2016 all of this data comes from the government, and therefore we aren't making big inroads into dealing with the fact that there aren't enough homes being built. And again, although that's bad for London as a whole, it obviously represents an opportunity for us, because we want to build more, and in that context there's plenty of scope for doing that. And the only other chart to just pick up on while we're on this page, the change in average private rents. The graph in the bottom right hand corner, the red line is change in private rents per year in London, and the gold line is the change in rents across the rest of the UK, noting that the change in rent there is percentage increase each year. So when it falls, it doesn't mean rents are falling, only when it goes below zero is that happening. Obviously rents in London have been strong in terms of their growth rates for a long time. That has built up a keenness for people to invest. It's one of the reasons why build-to-rent investment has picked up. It's one of the reasons why we've been so successful selling to individuals. The reason is there's such a strong tenant demand. You'll notice it's come down in the last year. A lot of that though is driven by prime properties rather than the properties that we're dealing with, where we still see strong rental demand and strong demand from tenants wherever we complete a development. And the final thing to point out is that dip where rents were falling in 2011, 2010, 2011 didn't last very long. So actually there's a long track record of rents increasing in London and performing well because we're not building enough homes. To some extent that covers quite a bit of the background to the market, but a couple of things just to point out as well. Although the background in terms of the supply-demand dynamic is the main thing that we look at and the main thing that drives what we're doing in the business and our ability to grow, things come along here and there that are negatives or positives that affect sentiment for a little while. Obviously the outcome of the EU referendum would have been a cause for concern, but only actually lasted for a short period of time. And even though we're still in a position of some political uncertainty, it doesn't change that underlying need for homes. So at the moment we're not too concerned by that ongoing political uncertainty or what's going to happen through the EU referendum from a demand side, and we're not seeing that have a massive impact on our demand. It might have an impact from a supply side, but we very much feel that although EU workers are critical to the construction industry in London, that is recognised by all of the major parties, including obviously the Conservatives, who presumably will be negotiating the EU exit, and that everyone realises it should be front and centre. We're not expecting a lot of that Labour to be to go home or to leave, because the industry, as well as many others, is dependent upon it. There have also been some tax changes, an extra 3% stamp duty for investors for second properties. Again, that hasn't had a massive impact on our demand. It affects individual yields a little bit, but it hasn't had a massive impact in terms of people not buying, particularly where they're investors that have a portfolio of properties and are looking to diversify between different investments. However, there has been a bit more impact from the phased removal of mortgage interest relief, which has only just started, but obviously investors are aware it's coming in. That only affects a UK-based investor, and that has seen demand from individual UK investors fall away in the last few months. However, the way we look at our market is that we've essentially got 4 different types of buyer, and they are individual investors, and the 2 classes of those really, although they shouldn't be seen as different things, but people do, are individual investors from the UK and individual investors from overseas. We've then obviously got now build-to-rent institutional investment, and we've also got owner-occupiers. So I mentioned a second ago that we've seen a lot less UK investors. The way we view our market is that we're not reliant on any one of those 4 groups, and indeed the percentage of buyers from each of those groups changes quite a lot between years. If you look at the line graph on the page of our presentation that should be in front of you now, or you can see now, you'll see that obviously build-to-rent, because we've started to do more transactions, has really picked up as a percentage of the actual property sold, and that's what all of these charts are. It's just a percentage of properties sold in any given year. It doesn't mean suddenly we're entirely doing build-to-rent. We're not. We now have a pipeline, a contracted pipeline of just under 500 build-to-rent homes in 4,000 in the whole pipeline. But obviously the fact that transactions have been in the last 12 months skews those numbers. But equally, if you look back over time, the investor number has moved up and down, the owner-occupier number has moved down predominantly. Although one of the reasons for that is that we've always been selling very early in the process, and owner-occupiers can only buy in the last 6 months. The key at the moment is there's strong demand from overseas investors. We had a very successful launch of our development at City North at the tail end of 2016, and we're also monitoring competitors when they go overseas for launches, and again demand is very strong there. And also there's very strong demand from owner occupiers. The fact that we've only got a small percentage of them buying at the moment is again a function purely of timing, not that they're not there. And so we don't see ourselves as reliant on any individual customer group, and in fact build to rent investment just adds another string to the bow one way or the other. So just picking up on that in a little bit more detail, from an individual sales point of view, we historically have made hardly any sales under Help to Buy, and we still haven't. We're up to about 25, 26 sales through Help to Buy. It is there, however, and it still is a backup to an owner-occupier having the money to purchase a home from us. We don't ever expect it to become a major part of our pipeline or a major part of our sales, but nonetheless it's there. I also think there's owner-occupier demand, and we've proven that with some of the sales we've made from people who aren't using Help to Buy, or perhaps are using Help to Buy that don't necessarily need to use Help to Buy. And therefore, we foresee that there will be owner-occupier demand in the future. It's certainly what a certain subset of the London market still wants to own their own home, albeit the push for rental homes is probably far stronger. But we are therefore targeting a broad spread of sales in the future, where we expect some of our sales to be upfront to institutions, some still to be to individual investors, but equally we feel we can hold back some of our launches to maximise the revenue from them, because prices will tick up at least at a stable rate over time, or they usually do, by selling to owner-occupiers at the end of a development. We talked a lot about the individual sales market and how we see the market context, and we've touched on build to rent a few times, but probably now is the right time to give a little bit more detail on what we're actually doing from a build to rent point of view. Really, it was only in February of 2016 that we did our first transaction, and we did that really because that specific development had been held up in planning. And we were looking for ways to accelerate it through the process, to bring the cash flows forward and the profit recognition forward. And build to rent had just really come about as a part of the market really. So we went through an agent and tried to find a buyer for the pavilions on Caledonian Road, just north of King's Cross. And we got such a strong level of demand and such a good price point in our eyes that it kind of opened our horizons to thinking about what build to rent could do for the business on a grander scale. On the back of the transaction we did with L&Q, we reviewed the rest of the pipeline and identified other developments that we owned that would work for build to rent. We did the same thing, and we've since the original one done 2 deals with M&G Real Estate, and another one with Notting Hill on a joint venture that we are in with them, or a division of Notting Hill. Again, alongside that, we've been attracting an awful lot of attention from investors, and I think the key there is we've met a lot of people and a lot of different institutions, but really they're coming to us rather than us coming to them, and that's quite a key part of it. There seems to be such a lot of demand out there that they're looking for developers that are interested in the sector. And from that point of view, I think we're in quite a good spot. Quite a few of our competitors don't see the same advantages as we do, and in a minute I'm just going to talk you through the pro forma margin comparison between a normal sale development and build to rent, and the reasons why we might find that attractive. But not all of our competitors, certainly larger competitors who aren't funded in the same way and don't take on debt finance, don't see the same advantages because they're not saving the need for debt finance or the interest costs. Equally, smaller developers who you might think would need the finance from build to rent investment don't always represent a counterparty risk that an institutional investor is happy with. So I think we're in quite a sweet spot. We're not the only people doing this by any means, but we are in a position where there's not a great deal of supply of build-to-rent developments. We're keen to do more, and yet there seems to be an awful lot of money chasing that short supply. We have skill sets that I think are helpful here, in that we manage getting through a planning process, we know where to find the land, and crucially we're in charge of the entire construction process as well. And I think that's important again to the investor. They know that we're in control of the whole development process. We do expect to do more, and of course I've talked about the fact we have a pipeline of contracted schemes of just under 500 homes out of the 4,000. And before we've said that we expect build to rent to be maybe up to half of our pipeline. But just after our results, we announced a significant transaction with Greystar, where we've signed a pre-construction agreement to build just under 900 homes for them in 9 Elms. And here again we've assisted through the process of buying the land. We'll be assisting in getting the planning consent, and we will be building the scheme. So we do see it as very similar to our other build-to-rent transactions in terms of our involvement across the whole process, and we will be earning a similar margin to the margin on other build-to-rent schemes. And just to touch on that for a second, if you can see the table that shows the different margins between our different streams of revenue, the individual sale table talks you through expected margin on a normal development basically. So we normally target a 24% gross margin. We have 4% selling expenses, 4% finance costs typically, and a net margin of 16%. Contrast that with build to rent. Now an investor does not turn up and say, I want a 12% discount. That's not how it works. They look at what the rental return will be. They capitalise it a yield, which is circa 4% on a net basis. And then they discount that for the fact that the scheme is forward funded, and that's the crucial difference here. We're getting paid as we build. There's a land payment up front, build payments through the build programme, and then an end payment on completion. So the capital return is very different. But typically that breaks back to around about a 12% reduction in the sales price, i.e. 88. That means a gross margin of 14%. There are rarely, if any, selling expenses, but we've put one in there just to cover the bases. And there are no finance costs. And here, again, we don't need to put any equity or any debt into these schemes. That's where the real benefit comes for Telford Homes. And without those finance costs and without the selling expenses, the net margin breaks back to 13%. So we're looking at a drop on a net margin of about 3% circa, in return for effectively an infinite return on capital from the point at which we undertake the transaction, and saving debt finance and not having to use our own equity on this scheme. So we do expect it to be able to grow the business in the future. We expect to do more with it, and clearly the Greystar transaction is kind of transformational, both from its scale but also from the nature of the partner, and perhaps the fact that it puts us really at the forefront of the London build-to-rent scene. And I think therefore hopefully that will lead to further partnerships and further transactions, and we do expect to do more build-to-rent in the coming months and years. I'm just going to hand over to Katie now to talk you through some of the numbers.
Good afternoon. So just on the page in front of you now, page 15, is a summary of the last 5 years' results. As you can see, a significant increase in both revenue and profits over that period, and we've set out we wanted to double profits between 2014 and 2018, and we're well on track to do that. So in terms of the current year, 2017, the year we've just ended, record revenues and record profit before tax, ahead of where we expected to be and ahead of where the market expected to be. Just breaking that down a little bit in terms of the different revenue streams and the margins compared back to the pro forma that John just went through. There was less revenue in the current year from our usual business, so the open market individual sales, which previously has made up a greater proportion of the business, typically around about 80%. This year There were fewer units handing over, individual units completing, but that was as expected and down to the fact that was the amount of stock physically available to hand over. So it's not that we were sat on lots of finished stock this year, it's just the timing of when units are ready to hand over. However, the reduction in that revenue was more than offset by the build to rent revenue and affordable revenue. So when we're recognising revenue from contracts such as build to rent and affordable, we're recognising throughout the contract, and therefore the contracts we've entered into this year and previous years in terms of build to rent, we're recognising the revenues this year. So a significant proportion of the revenue, as you can see on the pie charts, came from build to rent, and also the affordable homes what we're delivering to housing associations, which are still around about 20% of the revenue each year, about 35% of the units in each development. Looking at the margins, because effectively we've now got a blended margin between the open market individual sale and build to rent developments, comparing back to the pro forma on the page before. So in an open market individual sale, where we're targeting when we acquire sites a 24% margin, we were ahead of that at 25.4%, really because we've benefited from sales price inflation in the past and done a little bit better than we thought in terms of build costs in the year. And similarly on the build to rent, we're ahead of the 14% pro forma, what we're targeting in terms of when we're looking at sites for that type of product. Again, because we've done better than we thought on the land purchase and where we have expected it to come out versus when we acquired the sites originally, because the build to rent contracts we're in at the minute are on sites we owned in the past. They're not bought specifically for build to rent. Just looking back at the income statement, our selling expenses were relatively low this year as compared to revenue, and looking back over previous years, that's because we're seeing the benefit of build to rent developments. So we're not incurring the sales cost that we would have incurred had we released the units on the open market. So we have delivered significant growth, as you can see on the 5-year history, but we're still expecting significant increases in profits going forward, and we've stated we want to exceed profit before tax of 40 million in the current financial year and over 50 million in the following financial year, and we've already secured a lot of that in terms of what we've pre-sold. So 80% of the gross profit for the current financial year is secured with pre-sales, and 60% of the gross profit for 19 is secured. So in total, we've got pre-sales of 546 million that will be recognised over the next 2 years and beyond. In terms of our dividend policy, our normal policy is to pay 1/3 of earnings. However, we did a placing a couple of years back in 2015 and said as a result of that we'd pay a little bit more than 1/3 of earnings to remove the dilution, hence why we're paying a circa 40% in this year, 15.7 pence per share, an increase on last year, and a yield of around about 4% with the year-end share price. In terms of the balance sheet, we're increasing inventories as you would expect. We're growing the business and therefore we're investing in land, we're investing in work in progress. We don't typically land bank stock, so whatever we have got within our inventories number is working through the planning process or it's already under construction, and we don't have very much in terms of finished stocks. It is effectively capital being worked through to completion. We fund the developments where they're not built to rent, so the developments, individual sale developments where they require capital and equity, we fund through a combination of debt and equity, typically 60% debt funding. And we've got a facility with 4 banks, an RCF revolving credit facility of 180 million that we've had for a few years now with 4 banks that runs to 2019. And that's got headroom, a significant headroom within that to develop out the pipeline and develop out on the growth targets that we've set. Aside from that, if there's joint venture developments, we have separate joint venture funding and we put that in place as and when needed, and we've secured 2 new facilities in the year. One of 110 million with LaSalle at City North, and another one at Balfour Tower of 33 million with Williams and Glyn. So we've got the debt and we've got the headroom within the debt to develop the existing pipeline and grow beyond that. We haven't been using the debt facilities as much as we might have expected. Now gearing levels are relatively low at the year end, and they have been the last couple of years because we had the placing funds and we've had money coming back to us where we've sold existing pipeline to build to rent where they pay you back the land value. So gearing relatively low, but we are expecting that to increase as we are a growing business, and we've still got a big part of the business is still going to be the individual sale units, which will require debt. However, that is backed by the fact we've got pre-sales within the business, so we're not afraid to use debt given that we've got the pre-sales of close to 550 million versus where in the broker forecasts out in the market net debt's peaking around about 200 million.
So just try and wrap up now, so there's plenty of time for questions. Just a touch on development pipeline though. I've mentioned it a couple of times. We've got 4,000 homes in our development pipeline with a value of 1.5 billion. It's more than 5 times the revenue we made last year, which is where we want it to be. We're still focused on the non-prime locations. I've talked about the average price point as well. That's the key, making sure that average price point, which is £527,000 within the pipeline, is still affordable or relatively affordable in terms of the London market. We've acquired quite a few sites in the last few months, and we're probably seeing more opportunities now than we saw a year ago. So we are comfortable that the land is out there, the opportunities are out there, the competition is still the same, hasn't got any greater than it was before, and I think we're in a position where our reputation helps us to acquire schemes, certainly from London boroughs or public sector bodies and things like that. So I think we're very pleased with how things have panned out over the last few months, and as I say, there are a lot of opportunities out there to add to that in the future. And then finally, really before wrapping up, just from an operational point of view, obviously we've been growing a lot and we've still got growth to come. We have a very well established team across the business, a very high rate of staff retention, and we've got new people into the business wherever needed, and we're setting the structure to make sure we can cope with the growth. We aren't going to use build to rent as a reason to just accelerate phenomenally in the future. Clearly it doesn't need any money, so in theory you could just keep doing another build to rent scheme and another one and another one and another one, but actually that will break our operational model, so we're well aware of that, and whilst it can accelerate our growth, we won't let it become something that dominates the business. And clearly, although build to rent de-risks from a revenue point of view, it doesn't de-risk the build side of things. We back ourselves in terms of being very good at getting cost estimates right and programs right, but again, you need to be able to control that and get that right. So we're doing everything we need to do to make sure that that works. And then just wrapping up really, we're driven by the fact there aren't enough homes in London. We have got a very strong forward sold position. We've got a very good pipeline, and we've now got a new and I think quite exciting part of the business in terms of working with build to rent investors. So I think we're in a good place. We've got some very strong profit forecasts, and we've got a pretty robust market around us, so we're looking forward to the future.
Lovely. Well, thank you both very much, and congratulations on an excellent set of results. We've got a few questions here, so we shall kick off. The shape of the business has changed over the last few years. Let's start with the Balfron Tower, which is now ready to roll. Do you see similar stock held by your housing association partners as a potential for further acquisitions? And in addition, do you see office buildings with permitted development rights becoming of interest to you to read about?
So no and no. That's probably the easy answer to that. So Balfron Tower was part of our acquisition of United House back at the tail end of 2015. And we own a quarter of the scheme, so a relatively junior partner, albeit we are in control of the build and therefore managing the construction or the refurb of the scheme. But it's not really our traditional business model. We prefer new build. We're perfectly capable of doing refurbs and permitted development where needed, but we prefer new build. There's a different skill set involved in new build, and we think we can maximise returns from that. So we don't expect to move into it in a big way. Equally, we're not at all interested in permitted development rights. Actually, there's a bit less of that now, because I think the low-hanging fruit has already been picked off. And actually, because of permitted development rights, there's now quite a shortage of space for commercial enterprises who therefore make the relative values of commercial and residential a bit more challenging. So no, we expect to be a predominantly new build developer, and that's where the heart of the business really lies.
Mm. Well, and drawing on your closing comments, you said you didn't want the business to become too reliant on the build-to-rent market, despite the obvious opportunity there. Going forward, what percentage of the business would you be happy to see it become?
Yeah, I mean, it's difficult to necessarily fix a number in your mind, but we've said a couple of times now that we expect it to be maybe up to 50% of what we do. Mm-hmm. And when I say 50%, obviously it's already more than 50% of the sales we made last year. What I really mean is 50% of the pipeline. I said during that presentation that it kind of represents nearly 500 homes out of 4,000 in the pipeline now. With the Greystar deal, of course, when we've got into a full construction contract, which hopefully will be the end of this year, then we will then have 1,500 homes in the pipeline that are built to rent out of 5,000. So already we'll be making a huge step in the direction of it being 50%. So circa 50%, partly because we don't want to give up the skill set of selling normal homes on the open market. I mean, we want a little bit of both is the answer. There is a different skill set, obviously, involved in selling to individuals. It's what we do, it's what we know, and therefore we're hoping to strike the right balance between the two. But clearly we've still got a way to go before we get to 50%. So hopefully there'll be more transactions that move us on the way in the coming months and years. Okay,
well, one of our listeners has picked up on your repeated reference to your competitors. I think we was on the subject of the build to rent at the time. Perhaps would you like to expand on who you see as your main competitors?
Yeah, I mean, so I think other house builders have been getting involved in build to rent. We know that Countryside have done things, Bellway have done one scheme, Crest Nicholson have done a few things. But actually you don't see that many people that are saying they want to do it repeatedly and sort of stepping into the market in a big way. I think it's perfectly possible that sort of similarly sized private house builders will want to get involved in it, and I'm sure they already are to some extent. And that's probably distinct. There aren't really many similarly sized listed house builders, but there are quite a few that are of our sort of ilk. They're in the private market, and I think they might get more involved. Housing associations, of course, like L&Q and Notting Hill, whilst we've sold homes to them for build to rent, they're perfectly capable of doing their own thing as well. And so they may well be competition from that point of view. There are some bespoke build to rent developers, but again, people like Greystar obviously huge in America in terms of having control of over 400,000 homes over there, but they still need somebody to assist from a land point of view, a planning point of view to some extent, and a build point of view. So we may be up against some contractors in the future, and then there'll be people moving in and out of the sector. But at this point in time, as I said, I think we're in a bit of a sweet spot. So yeah.
Thank you. One for you, Katie. You have touched on your the headroom that you've still got in your 180 million banking facility. So it doesn't sound like that's going to be, of course, any hampering in the business of growth, but perhaps then we can turn that around and ask sort of, going forward, what levels of gearing we can expect to see in the business, and at the higher end, what would you be comfortable with?
Okay, yeah, so we have got good relationships with our banks, and we have got a facility in place, and as I said, we've put 2 more facilities in place as and when they're needed, and for the joint ventures this year. We are expecting to use the main revolving credit facility plus the joint venture facilities. We're on a growth path, and therefore it is a capital intensive business, and we will use the facility. So we're expecting gearing to increase, and the broker notes out in the market expects gearing to peak at around about 80% by the end of this financial year. Then with an overall longer to medium term, I suppose, aim to reduce gearing down as we become a bigger business. We are expecting then gearing to reduce, and part of that will be driven by the increased amount of build to rent that we're intending to do, which doesn't require any capital or equity, and therefore using build to rent not only to de-risk the business in terms of a sales point of view, but reducing our overall levels of gearing closer to 50-60%. Again, but then it's secured by pre-sales, but increasing this year with a view then longer term to decreasing.
Okay, thank you. We're touching briefly, obviously, tragedy yesterday at Grenfell Tower. But one of our listeners wants to perhaps have some reassurance that, particularly in the Balfron Tower instance, that...
Yeah, I mean, obviously, don't know exactly what happened in terms of Grenfell Tower, but as you can probably imagine, there are, leaving Balfron aside for a minute, there are some very different requirements on new build developments, which of course is pretty much all that we do, and including sprinkler systems and lots of other things that unfortunately weren't part of what's gone on at Grenfell. So it's very different new build versus something that's being refurbished. In the case of Balfron Tower, that's not the same as Grenfell, where it was just refurbished from the outside or people were still living in it. Balfron Tower is now empty and is being completely gutted, essentially, and redone internally, including a sprinkler system and including sort of the right sort of cladding and everything else, again, without necessarily saying that we know what's happened at Grenfell. We don't. But obviously it'll be in accordance with all the regulations, as it always is. So I think, unfortunately, perhaps a very different situation in terms of what happened yesterday.
Yeah. No, well, moving swiftly on then, perhaps we would just take a look at the business in terms of its PLC status. Obviously been listed on AIM now for about 15 years. You know, are you still attracted to staying on AIM? Do you see advantages to moving up to the main list in terms of the additional shareholders you might attract to a growing business?
Yeah, I think we're not by any means the biggest company on AIM, and we're not really taking advantage of any lesser regulation or anything like that, because we try to act and behave like a full listed company would. However, we do have the advantage that a number of our shareholders at the moment are inheritance tax funds, and we need to bear that in mind, and that has been a feature of our shareholder register for a long time now. We've also got to get to the stage where we're confident that if we did move, that we'd get demand and traction and interest from a different class of investor. So the answer is at the moment really no plans, because we've been happy with how we've done on AIM. It's helped us to raise money on a repeated basis. Not that we have that in our plans in the future, but it has helped us to raise money. And as I say, we've got a lot of inheritance tax funds invested in us. So no plans to change at this point in time is the answer.
Okay, thanks. Well, I think we shall wrap it up with this final question. I suspect I know your answer. But given that we have had an election since you announced your results and today's presentation, you know, does the result of the election in any way give you hope for more opportunity going forward, or is the lack of homes a underlying
well, I don't think the result of the election necessarily was exactly the one that we might have wanted, because it's just added to a bit more uncertainty one way or the other. However, having said that, before the election, I was quite clear that all the parties want to build more homes. That remains the case now. So everybody wants to build more homes. That clearly is the key requirement, both in London and outside of London. We could do with some stability, obviously. We could do with not thinking there's another election coming. I don't think there necessarily will be. We could do with knowing what we've got in terms of a working government sooner rather than later. And then we could do with some stability in terms of the Brexit negotiations as well. So my hope is that there'll be some sort of agreement that enables a working government to get started on the Brexit negotiations and to provide some stability, because I think in the context of a market where we're not building enough homes, that's all great, and all we really need is a stable economic environment around that, and then all should be well.